If you want a near 90% win rate, this is possible with options. In this video, we dissect an option strategy that could make such a win rate a reality for you. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
Hi, I'm Seth Froberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if you've been trading for any length of time, you've probably gone through a slump in your trading where no matter how hard you try, no matter how much research you do, how solid you think your trading ideas are, you just have trouble sustaining any kind of consistency in your trading. And that can get demoralizing. And in fact, some traders get into a rut like that and never get out of it and end up quitting trading, which is tragic because some people who had the potential of being great traders end up quitting before their careers really get started and their dreams of becoming full-time traders are dashed. And so when a trader gets into a slump, one very good practice is to find a strategy that has a very high probability of winning, something reliable that is going to produce a win for you most of the time, which can be incredibly therapeutic if you're feeling demoralized. So if any of this sounds familiar, you're going to want to stick around so that we can explain the very simple steps necessary to implement this option strategy and hopefully get you back on a winning track and, more importantly, a winning mindset. Now, before we get into the strategy we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing now on your screen, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so as most of you know, the stock with the ticker symbol QQQ, also known as the Qs, is an ETF, an exchange traded fund, which has in it a basket of stocks that represent the NASDAQ 100 stocks, that well-known index that is loaded with the major tech stocks that we all know and love, such as Apple, Amazon, Alphabet, Meta, Tesla, etc. And so let's take a look at QQQ stock on May 1st of last year. And as you can see, the stock had a very, very rough 2022, losing more than 35% of its value at one point. But since January 2023, the index had been rallying all year, opening that day at 322.12. And so let's say that you were of the opinion that the Qs were going to continue to bounce and that 2022 will be seen ultimately as a buying opportunity. And so with your bullish bias, you decided to execute a campaign of high probability options trades that would be consistent with your premise. And so let's pull up an options chain on that day that expires about a month later on June 23rd. And you'll notice that there's a column called Delta that you'll see on any brokerage platform that supports options trading. And so we're going to look for the put option, which is about 10 deltas, which in this case is the 295 put option, as you can see. And we're going to sell 10 of those for a price of $1.26. And we're going to go simultaneously buy 10 of the 290 puts, which are 5 points lower on the options chain. And we'll pay 93 cents for those. And so what we've just executed is what is known to options traders as a 10 delta put credit spread. And so to explain what's going on here, what is known as an options delta is a mathematically arrived at prediction of how much an options price is likely to move based upon how much the stock price moves. And while it's a kind of a complicated topic, suffice it to say that an options delta has also been found to be highly correlated to the probability that an option will expire with any value on the day it expires. And a put option, of course, only has value on expiration day if the stock's price closes below the put strike price, because only then could you sell your shares of QQQ for more than they're trading in the market. Because if they close above the put strike price, then the put option expires with no value, because there's no value to an option to sell your shares for less than you could sell them in the open market. And so the 10 delta option has approximately a 10% chance statistically of expiring with value. And so obviously the one we bought 5 points lower has an even lesser chance of expiring with value. And so logically, two options that have equal to or less than a 10% chance of expiring with value logically have a 90% chance of expiring worthless a month later when they expire on June 2nd. And that's common sense, right? Because the stock is trading at 322 and it's been bullish all year. And so the chances of the stock closing below 295, 27 points lower in a month, are pretty small if you think about it in a common sense way. Okay, so now let's analyze what has happened here from a cash flow standpoint. As you can see, we sold those 295 puts for $1.26. Each option contract, of course, represents 100 shares of stock. So we multiply that price by 100, and we sold 10 of them. And so multiplying it all together, we would have received $1,260 for selling those 10 puts. And with the same kind of math, you can see we would have paid $930 for the 10 290 puts, resulting in net cash flow of $330 into our account. And please note that your broker is going to require you to have at least $4,670 in your account to make this trade in the first place. But of course, if you got less than that in your account, you can just go ahead and reduce the lot size to 5 lots or 2 lots or whatever, and the capital size required by your broker will be reduced proportionally. Moving to the day this trade expires on June 2nd, you can see that right after we got into the trade, the Qs rallied pretty strongly, closing at 354.65 on the day the put credit spread expired. And so we're now in a position where we can assign a final value to the options. And that's very straightforward in this case, because starting with the initial $330 that we received when we sold the spread initially, you can see that the 295 puts obviously expired worthless because they're located so far below where the index closed. And of course, the 10 290 puts that we owned expired worthless as well, as those are even farther below the closing price. And therefore, both options expired worthless, which means we can just pocket the $330 that we received initially for selling the put credit spread in the first place, because both of the options went out with no value. And that all makes a lot of sense because we started the trade with those options so far below the Q's price at the start of the trade, and the stock rallied, so it all kind of makes sense, right? And one more important thing to think about, which really shows you in a practical sense why this trade has such a high probability of winning. Think about the fact that the spread would have had the exact same outcome, both options expiring worthless, and thus a $330 profit at any price above 295, which means that the stock could have even gone down after we entered the trade and gone down a fair bit, and we still would have made the $330. We still would have had that same outcome, even though it is in essence a bullish trade. And so by now, you're starting to get the idea behind why this trade is so probable. At any price, from a decent sized drop in the stock all the way up to a huge rally in the stock, and you get the same outcome, a positive $330 gain. Okay, so now that we've wrapped up that trade, and assuming we're still bullish, we would enter the next trade expiring a month later, just like we did in the first trade. And so we pull up the July 7th options chain, which expires about 35 days later. And just like the last time, we find the 10 delta put option, which in this case is the 327, and we sell 10 of those for, in this case, $1.30. And just like we did last time, 5 points lower, we buy 10 of the 322 puts in this case for 97 cents. And so that actually yielded the exact same amount of cash flow as did the first trade, which isn't that surprising because it's basically the same trade repeated a month later. But normally, there's going to be some variance in the pricing, so there's no reason to be concerned if in different environments you receive greater or lesser amounts of positive cash flow when you do this trade. Okay, so we'll now move forward to the day that the spread expired, 35 days later on July 7th. And as you can see, the Q's rally continued closing at 366.24. And so with both the 327 and 322 put positions, again closing far below the stock's closing price, the outcome is identical. Both puts expire worthless, and the 330 initially collected falls right to the bottom line as trade profit. And so we continue like that month after month, selling 10 of the 10 delta puts and buying 10 of the puts 5 points below that. And remarkably, in this particular example of the last 12 months, from May of 2023 to May of 2024, we won all of them for a total profit of $3,850. And as you can see, if you scan this list, most of the monthly profits were about the same size. And since each case, both puts expired worthless, that means that the monthly premiums were very close to the same in each case. And those premiums just got pocketed at the end of each month because in each case, the Qs closed above where the puts were located that month. Now, for the period that we were running this back test, the peak capital required was $47.30. In other words, the most we would have had to have in our account at any time was $47.30, which took place on that February trade where we only collected $270. And so the return for the entire campaign can be conservatively stated to be 81.3%. Now, before we wrap up, I do want to make sure you understand some caveats. First of all, this whole campaign was premised on the fact that you are bullish on the Qs at the beginning of each month. If you're not bullish, you've got no business making this trade because if the stock sells off and your short puts finish above the closing price of the stock, you'll be required to buy shares of the stock at a price higher than they're trading for in the market. So to avoid having to do that, you should buy the puts back and close the trade before expiration if you don't have the cash to take delivery of the shares, incidentally. But you will almost definitely still lose on the trade that month because the puts you sold in that case will have blown up in value far beyond what you were paid for them, and you'll have to buy them back at that inflated price. In any event, it's unusual to win all 12 in any 1 year period. An average of 10 or 11 wins per year could be a more realistic estimate of this strategy over time because that's a win rate of about 90%, which is what the 10 delta trade is suggesting in the first place. That's not at all to say you can't lose more often than once or twice a year, by the way. We're talking long-term tendencies here, not a prediction of how any 1 year will turn out. And since in some years you will have lower win rates, your return in those years is naturally going to be worse. And in fact, in some years, you could theoretically have a loss completely for the year if you have too many instances of losing trades of some magnitude. But having said that, this trade can be a real morale booster for a trader who's struggling and looking for an aspect of his trading portfolio that's very likely to win pretty much in any given month. Professional traders are aware of these high probability trades that options can provide, and they take advantage of them strategically. And now you have some insight into why.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.